Hey crypto warriors, welcome back to Boni's Life. I'm your host Boni, and if you're watching this on July 27th, 2025, then buckle up because we're about to dive into what might be the most critical week in Bitcoin's recent history. And trust me, when I say critical, I mean the kind of week that could either launch us toward that legendary six-figure milestone or send us back to the drawing board. Before we jump into the technical wizardry and fundamental fireworks, let me ask you something. Have you ever felt like you're standing at the edge of a financial cliff, not knowing whether you're about to witness a spectacular launch or a dramatic fall? Well, that's exactly where we are right now, with Bitcoin trading in this tight $115,000 to $120,000 range. But here's the thing that gets my analytical mind racing. We might only have about 100 days left in this current cycle. Yes, you heard that right, and I'll explain exactly why in just a moment. Now, I know some of you are thinking, Boni, you always say every week is critical. And you know what? You're absolutely right to call me out on that. But this week is different, and I'm going to prove it to you with cold, hard data from some of the most respected institutions and analysts in the space. We're talking about Citigroup's latest Bitcoin forecast, Michael Saylor's updated price targets that'll make your head spin, and regulatory developments that could reshape the entire crypto landscape. So grab your favorite trading beverage, whether that's coffee, energy drinks, or whatever keeps your neurons firing, because we're about to embark on a journey through technical analysis that'll make sense of last week's price action, fundamental analysis that'll prepare you for the week ahead, and trading strategies that could help you navigate these choppy waters like a seasoned captain. Let's start with the technical picture, because if you're going to trade Bitcoin successfully, you need to understand what the charts are actually telling us. Last week, Bitcoin gave us a masterclass in consolidation, and I mean that in the most educational way possible. We saw Bitcoin dancing between $115,000 and $120,000, creating what technical analysts call a symmetrical triangle pattern. Now, for those of you who are newer to technical analysis, a symmetrical triangle is like watching two armies slowly approaching each other on a battlefield. The upper resistance line represents the sellers saying, "Not so fast," while the lower support line represents the buyers saying, "We're not backing down." And right now, these two forces are getting closer and closer to a decisive battle. The volume profile during this consolidation tells us something fascinating. We've seen decreasing volume as the price compressed, which is exactly what you'd expect in a healthy consolidation pattern. It's like a coiled spring gathering energy for the next major move. But here's where it gets interesting. The volume spikes we did see occurred primarily on the bounces from support, suggesting that institutional buyers are still very much present and active. Let's talk about the key technical indicators that are flashing some serious signals right now. The Relative Strength Index, or RSI, is sitting at a neutral 52, which means we're neither overbought nor oversold. This is actually perfect positioning for a breakout in either direction. The MACD is showing a slight bullish divergence, with the histogram starting to tick upward even as price remained relatively flat. But here's where my technical analysis gets really interesting, and this is something I learned from studying the 2017 and 2021 cycles extensively. The 200-week moving average just crossed above $50,000 for the first time in Bitcoin's history. More importantly, Bitcoin's realized price, that's the average price at which all Bitcoin was last moved, has crossed above this 200-week moving average for only the second time ever. The last time this happened was November 2020, and what followed was absolutely spectacular. Bitcoin rallied 212% in just 90 days. Now, I'm not saying history will repeat exactly, but as Mark Twain supposedly said, it often rhymes. If we see even half of that trajectory from current levels, we're looking at Bitcoin potentially reaching $250,000 by mid-October. The Fibonacci retracement levels are also telling us a compelling story. Bitcoin has been respecting the 38.2% retracement level at around $115,000 as strong support, while the 23.6% level at approximately $120,000 has been acting as resistance. This is textbook consolidation behavior before a major move. From a market structure perspective, we're seeing higher lows being formed on the daily time frame, which is a bullish sign. The fact that each dip is being bought more aggressively than the last tells us that institutional demand is not just present, but growing stronger. This is particularly evident in the order book analysis, where we can see significant bid support building around the $115,000 level. Now let's shift gears and talk about the fundamental factors that could act as major catalysts this week. And when I say catalysts, I mean the kind of events that could send Bitcoin shooting in either direction faster than you can say diamond hands. First up, we have the Federal Reserve's interest rate decision on July 29th and 30th. Now I know what you're thinking. Boni, the Fed always keeps us guessing. And you're absolutely right. But here's why this meeting is different. We're seeing persistent inflation pressures, and any surprise hawkish pivot could send risk assets, including Bitcoin, into a temporary tailspin. Conversely, any dovish signals could fuel the next leg up in this crypto bull market. The relationship between Bitcoin and traditional risk assets has been strengthening, and that's both a blessing and a curse. When the Dow Jones rally stalled at its December-January high earlier this week, we saw Bitcoin slide from around $120,000 to $115,000. This correlation means we need to keep one eye on traditional markets and one eye on crypto-specific developments. Speaking of crypto-specific developments, July 25th brought us the SEC's decision on the Rex Osprey Spot XRP ETF. This is potentially huge because it would mark the first XRP Spot ETF approval and could trigger renewed institutional interest in Ripple's ecosystem. The ripple effects, pun intended, could extend far beyond XRP itself, potentially signaling the SEC's willingness to approve ETFs for other major altcoins. But wait, there's more. July 31st is the deadline for the SEC's decision on Bitwise's BITW Spot ETF proposal. With growing institutional demand for direct crypto exposure, a positive ruling could add serious fuel to the current rally. However, if we see another delay, it could inject uncertainty into the market at a critical technical juncture. The regulatory landscape is evolving rapidly, and this is where things get really exciting from a fundamental perspective. The Genius Act was signed into law on July 18th, providing a federal framework for stablecoin regulation. This kind of regulatory clarity is exactly what institutional investors have been waiting for. Even more significant is the Strategic Bitcoin Reserve Executive Order signed back in March. The fact that the United States government is actively building a Bitcoin stockpile sends a powerful signal to other nations and institutions. When the world's largest economy treats Bitcoin as a strategic asset, it's hard to argue against its long-term value proposition. The supply dynamics are absolutely fascinating right now. Since January 2024, Bitcoin ETFs have absorbed over 1.2 million Bitcoin, and most of that isn't coming back to the market anytime soon. Corporate treasuries hold over 870,000 Bitcoin, with MicroStrategy leading the charge with 607,770 Bitcoin worth approximately $73 billion. Sovereign holders account for another 500,000 Bitcoin, and we haven't even factored in the estimated 1.5 million Bitcoin that are likely lost forever. When you add all this up, we're looking at over 4 million Bitcoin. That's more than 20% of the total supply. That's effectively removed from circulation. In any market, when you reduce supply while demand remains constant or increases, there's only one direction for price to go. Now let's dive into what some of the most respected voices in the space are saying, because sometimes the best insights come from those who've been in the trenches longer than most of us have been awake. Michael Saylor, the man who literally bet his company on Bitcoin, just updated his price target to $21 million by 2046. Let me repeat that. $21 million per Bitcoin. That represents a 17,400% gain from current levels, translating to a compound annual growth rate of 27.9% over the next 21 years. Now, before you start planning your retirement, remember that Saylor's thesis is based on Bitcoin capturing an increasing share of global wealth as traditional assets lose purchasing power to currency debasement. Saylor's conviction isn't just talk. MicroStrategy continues to aggressively accumulate Bitcoin, making them the largest corporate holder on the planet. Their strategy of raising capital specifically to buy Bitcoin has influenced other companies to follow suit, creating a positive feedback loop of institutional demand. On the institutional front, Citigroup just released their latest Bitcoin analysis, and it's remarkably bullish. Their base case scenario has Bitcoin reaching $135,000 by the end of 2025, driven by strong ETF demand and favorable macroeconomic trends. But here's where it gets interesting. Their bull case scenario projects $199,000 if ETF inflows and adoption accelerate. Even their bear case of $64,000 assumes we're still in a bull market, just with some regulatory or economic headwinds. Tom Lee from Fundstrat, who accurately called Bitcoin's 2024 peak, is maintaining his $250,000 target for 2025 while suggesting Bitcoin could reach $3 million in the long term. Lee's analysis focuses heavily on supply-demand dynamics and the impact of the halving cycle, which continues to reduce new Bitcoin supply every 4 years. From a regulatory perspective, the tone has shifted dramatically. The passage of crypto-friendly legislation like the Genius Act and the CBDC Anti-Surveillance State Act signals a government that's embracing rather than fighting digital assets. The upcoming White House crypto policy report on July 30th could provide even more clarity and potentially more bullish catalysts. But let's not ignore the bears entirely, because balanced analysis requires considering all perspectives. Some economists worry about Bitcoin's correlation with traditional risk assets, arguing that in a real economic downturn, Bitcoin might not provide the safe haven properties that many investors expect. Others point to the environmental concerns and potential regulatory backlash as long-term headwinds. However, the institutional adoption narrative continues to strengthen. When you have companies like MicroStrategy, Tesla, and numerous others holding Bitcoin on their balance sheets, and when you have countries building strategic Bitcoin reserves, it becomes increasingly difficult to argue that Bitcoin is just a speculative bubble. Here's where things get really fascinating, and this is the analysis that's been keeping me up at night. According to historical cycle analysis, we might only have about 100 days left in this current Bitcoin bull market. Let me break down the math for you. We're currently around 975 days into this cycle from the cycle low. The 2017 bull market topped out at 1,068 days, while the 2021 cycle peaked at 1,059 days. If we average those two, we get a potential peak around October 19th, 2025. That's roughly 100 days from now. Now, I can already hear some of you saying, but Boni, this time is different. And you know what? You might be right. The ETF inflows, the institutional adoption, the regulatory clarity, these are all factors that didn't exist in previous cycles. The supply dynamics have fundamentally changed, with over 4 million Bitcoin effectively removed from circulation. But here's the thing about markets. They have a way of humbling even the most confident analysts. Every cycle, people argue that this time is different. And while the fundamentals may be stronger, the cyclical nature of markets tends to persist. Until we have concrete evidence of a supercycle, the prudent approach is to assume we're still operating within the traditional 4-year cycle framework. The MVRVZ score, which measures the ratio of market cap to realized cap, is showing similar patterns to previous cycle peaks. This indicator has been remarkably accurate at identifying market tops and bottoms throughout Bitcoin's history. While we're not yet in the extreme euphoria zone, the trajectory suggests we could get there within the next few months. If we do see a parabolic move similar to previous cycles, the mathematics become quite compelling. Bitcoin has historically delivered its most explosive gains in the final 90 days of a bull market. In 2017, Bitcoin doubled in just 2 weeks when it crossed $10,000. Even in this cycle, we've seen Bitcoin rally nearly 100% in under 100 days, leading up to the $100,000 milestone. Alright, let's get to the part you've all been waiting for. How do we actually trade this setup? Because all the analysis in the world doesn't matter if you can't translate it into profitable trades. First, let's establish our key levels. The $115,000 level has proven to be strong support, acting as our line in the sand. As long as Bitcoin holds above this level, the bullish structure remains intact. A break below $115,000 with volume would be our first warning sign that we might be entering a deeper correction. On the upside, $120,000 is our immediate resistance level. A clean break above this level, especially with strong volume, could trigger the next leg up toward $125,000 and potentially $130,000. These aren't just random numbers, they're based on Fibonacci extensions and previous significant levels. For swing traders, the strategy is relatively straightforward. Look for bounces from the $115,000 support level with tight stop losses below $114,000. Your target should be the $120,000 resistance level, giving you a risk-reward ratio of approximately 1 to 5. If we break above $120,000, you can trail your stops and look for extended targets. Day traders should focus on the 4-hour and 1-hour time frames. The consolidation pattern we're in creates excellent range trading opportunities. Buy near support, sell near resistance, and keep your position sizes manageable because breakouts can happen quickly and violently. For those of you who prefer a more systematic approach, consider using a breakout strategy. Set buy orders above $120,500 with stops below $118,000. This gives you immediate exposure if we see an upside breakout while limiting your downside risk. Similarly, if you're bearish, you could set sell orders below $114,500 with stops above $117,000. The options market is also providing some interesting opportunities. The implied volatility has been relatively low during this consolidation, making it an attractive time to buy options if you expect a big move in either direction. A long straddle strategy could be profitable if we see the breakout that many are expecting. Risk management is absolutely crucial in this environment. We're at a critical juncture where a move in either direction could be significant. Never risk more than 2 to 3% of your trading capital on any single trade, and always have a plan for both scenarios, breakout and breakdown. For longer-term investors, this consolidation period might be an excellent opportunity to dollar-cost average into positions. The technical setup suggests we're more likely to break higher than lower, but even if we see a temporary correction, the fundamental backdrop remains strong. Let me walk you through the specific events this week that could trigger significant price movements, because timing is everything in trading. Monday and Tuesday are likely to be relatively quiet, but don't let that fool you. Often, the biggest moves happen when everyone least expects them. Keep an eye on any unexpected news flow, particularly around regulatory developments or major institutional announcements. Wednesday brings us the start of the Federal Reserve meeting, and this is where things could get interesting. Any leaked information or preliminary statements could move markets before the official announcement. Bitcoin's correlation with traditional risk assets means we need to watch the bond market and equity futures closely. Thursday, July 30th, is the big day. We get the Fed's interest rate decision and Jerome Powell's press conference. But equally important is the expected release of the White House's first comprehensive crypto policy report. This could provide significant clarity on the administration's approach to digital assets and potentially announce new initiatives or regulatory frameworks. Friday, July 31st, brings us the SEC's deadline for the Bitwise BITW ETF decision. Given the recent approval of Bitcoin ETFs and the growing institutional demand, a positive decision could provide a strong finish to the week. However, any delay or rejection could dampen sentiment heading into the weekend. The key is to position yourself before these events, not after. By the time news breaks, the market has often already moved. This is why understanding the technical setup is so important. It helps you position for the most likely outcomes while managing risk if you're wrong. While we're focused on this week's events, it's important to keep the bigger picture in perspective. Bitcoin is still in the early stages of institutional adoption. We're seeing pension funds, insurance companies, and sovereign wealth funds beginning to allocate to Bitcoin. This is a multi-year trend that's just getting started. The upcoming Solana ETF decision in October could be another major catalyst, potentially opening the floodgates for altcoin ETFs. Argentina's comprehensive crypto regulatory framework, due by year-end, could set a precedent for other Latin American countries. The supply dynamics continue to favor higher prices over the long term. With the next halving still a few years away and institutional demand continuing to grow, the fundamental case for Bitcoin remains compelling regardless of short-term price movements. As we wrap up today's analysis, let me leave you with some hard-earned trading wisdom. Markets are humbling, and they have a way of making fools of even the most confident analysts. The key to long-term success isn't being right all the time. It's managing risk and staying in the game long enough for the probabilities to work in your favor. The technical setup suggests we're coiled for a significant move. The fundamentals remain strong, and the institutional adoption story continues to unfold. Whether we see the breakout this week or next month, the important thing is to be prepared for both scenarios. Remember, successful trading isn't about predicting the future with certainty. It's about positioning yourself to profit from the most likely outcomes while protecting yourself from the unexpected. The Bitcoin market rewards patience, punishes greed, and always keeps us guessing. Keep your risk management tight, your analysis objective, and your emotions in check. The next 100 days could be some of the most exciting in Bitcoin's history, and I'll be here every step of the way to help you navigate these markets. That's a wrap on today's analysis, crypto warriors. If this breakdown helped clarify the week ahead, smash that like button, subscribe for more market insights, and ring that notification bell so you never miss an update. Drop your thoughts in the comments. Are you bullish or bearish for the week ahead? And remember, this is not financial advice. Always do your own research and never invest more than you can afford to lose. Until next time, this is Boni reminding you to trade smart, stay safe, and keep building that crypto wealth. See you in the next one.